Hi there, I'm Starling and this is Market Unpack. Today we're looking at forward and futures pricing. Suppose you want to buy gold in 3 months. What price should this contract have? The correct price is surprising the first time you see it, but there's a really nice no-arbitrage argument for why it has to be that. Let's discuss. We want to buy gold in 3 months. More specifically, we want to enter into a contract now that lets us buy 1 ounce of gold at price F in December. Let's call this a futures contract for now and discuss specifics later. What should the futures price F be? Here's a chart of the price of gold from the LBMA. Figure 1. Price of 1 ounce of gold as determined in the LBMA twice-daily auctions. The price at the end of September 23rd was $2,629.95 per ounce. When I first considered this question years ago, I thought it was asking for a prediction of the price of gold in 3 months. After all, we're talking about the price of the future. For example, if you figured out that the price of gold will be $3,000 in December, you'd want to buy the future for $2,900. On settlement day, you'd pay $2,900 to close the futures contract and get the gold, then sell it immediately for $3,000, thus pocketing a $100 profit. Other people would also be doing this kind of trading, so the actual price would be pulled to somewhere in the vicinity of the $3,000 consensus. Now, how can we predict the future price? We could take a technical approach. Note that the price increased from $2,328.75 to $2,629.95 over the last 3 months, and concluded that it will be about $2,930 in December. We could also take a fundamental approach and construct a model out of supply and demand. Then, we'd find this survey by the World Gold Council, which predicts that central banks will be buying more gold in the future, add this demand to our model, and come up with a price prediction. For simplicity, let's go with the $2,930 technical prediction. How does this compare to the actual price of the futures contract traded on CME? The real price for the December expiration is $2,652, which is nowhere close to our prediction. In fact, the $2,930 figure won't be reached until June 2030, according to the futures prices. What's going on here? Is the market predicting a sharp pullback in the price of gold? No. The problem is that our reasoning was very narrow and considered only one strategy. Basically, we were thinking like a speculator, but the speculative prices allow for a very simple arbitrage, so the price is overwhelmingly determined by arbitrageurs. Suppose the current spot price of gold is $2,630 and the December futures price is $2,930. The simple arbitrage is to do the following. Sell 1 ounce of $2,930 futures contract for December at zero immediate cost. Borrow $2,630 for 3 months at 5.35% interest. Buy 1 ounce of gold for $2,630 and hold until settlement. Close the futures contract with the gold held in December, making a gain of $300. Repay the loan with $35 interest. Finish with a profit of $265. That's $300 gains from the future minus $35 of interest paid. The above is clearly profitable, and it isn't even that hard to execute, so many people would be doing it. This works as long as the futures price is higher than the gold price plus the cost of borrowing money. What about the other way around? Suppose the price of gold is $2,630 and the December futures price is $2,330. The arbitrage is to do the following. Buy 1 ounce of $2,330 futures contract for December at zero immediate cost. Short sell 1 ounce of gold at $2,630. Invest the $2,630 at the risk-free rate of 5.35% for 3 months. Pay $2,330 to close the futures contract in December and receive 1 ounce of gold. Close the short position with the held gold. Finish with a profit of $335. That's $300 from the short plus $35 of interest received. This arbitrage works as long as the futures price is lower than the gold price plus interest. The recipe above says to short gold, which is an unusual operation, but the trade doesn't actually require shorting per se. It just requires selling. In other words, as long as there are traders who have gold and are willing to sell it for 3 months, they can do the arbitrage. So we know there's an arbitrage that will depress the futures price until it's lower than the gold price plus interest. And we know there's a second arbitrage that will raise the futures price until it's higher than spot plus interest. Therefore, assuming an efficient market where all arbitrages are already happening, the futures price should be equal to spot plus interest. In other words, F is equal to S times E raised to the power of R times T, where F is the futures price, S is the current spot price, R is the risk-free interest rate, and T is the duration of the contract in years. Here, we're assuming the interest rate is continuously compounded. The formula would change slightly if it were compounded differently, but that wouldn't affect the overall argument. This is the no-arbitrage argument for what the futures price should be. Now let's see if reality matches up. Reality. We now compare our calculation of F to the real settlement prices from CME for the next 6 months. Table 1. The real CME and calculated prices for the next 6 expirations of gold futures. The TTS column is the number of years until expiration. The interest rate column is the SOFR rate for the same period of time, calculated as a straight line interpolation between the official 30 and 180-day rates. The calculated price column is what we got, and the real price column is what is being traded on CME. The error column is the difference between the latter two. The implied rate column shows what the interest rate should have been when plugging the real price into our formula. The immediate observation is that, while close, our numbers don't perfectly match reality, and the error seems to increase the further out we go, reaching almost 1% for April 2025. That said, the real numbers do fit the pattern we were expecting to see. They seem to be increasing by some factor which grows the longer the time to settlement is. In other words, the shape of our formula seems right, but we're missing something. Our first hint as to what's going on comes when we consider the September 27th expiration. That's in 3 days from the time of writing. The spot price should be almost identical to the futures price, because there's not much you can do in 3 days. Instead, the real price is $3.45, that's 0.13%, lower than the actual spot price. Going back to our arbitrage argument, this means you could sell gold at $2,629.95, buy the future at $2,626.50, settle everything in 3 days, making a profit of $3.45. A possible explanation is that the trades incur fees, and the 0.13% difference does indeed look like the kinds of fees an exchange would charge. So, even though it seems like there's an arbitrage here, you can't actually trade on it profitably. A second explanation would be that our price sources aren't completely in sync. The gold price comes from LBMA's afternoon auction, and the futures price is the end of day 1 on CME. Since the two aren't determined at exactly the same time, it's unsurprising that they're slightly different. Realistically, the actual reason is a combination of the above. Another factor we haven't considered is storage fees. After all, operating a secure vault to store gold is expensive. Going by Royal Mint's website, a retail investor would be charged 0.5% per year. Looking back at our arbitrages, this rate would be added to the interest rate cost of the money borrower, and it would be an extra saving for the gold seller. So the real equilibrium price wouldn't be S times E raised to the power of R times T, but instead would be S times E raised to the power of R plus C times T, where C is the storage cost expressed as a yearly rate. We also made the assumption that traders can borrow and lend at the risk-free rate, SOFR in our case. Not everyone can do this, I certainly can't, but we only really need enough people to have this capability in order for the arbitrage to work. So I don't think this is much of a factor. We're still missing something. Looking at Table 1, we see that the real prices are consistently lower than our calculated prices. This means that the buy futures sell gold part of the arbitrage isn't working perfectly. This is the harder trade since it requires one to either already have gold or be able to borrow it. In other markets, the people who do this kind of arbitrage are the large banks, but regular banks don't make a habit of holding lots of gold. Central banks do, but they might be wary of replacing their gold holdings with futures because their remit is to hoard gold, not chase yields. I've seen references to gold being lent out, but I couldn't find any public data on the interest rate charged. So this half of the arbitrage is probably just not perfectly efficient in the real world. Our final observation is that the interest rate implied by the futures prices starts off as negative but grows and seems to stabilize at around 1.5% lower than the risk-free rate. This implies that the buy futures sell gold part of the arbitrage is more expensive to do in the very short term, less than 3 months, than in the medium term, over 3 months. I don't know why this happens, but I speculate that the players capable of doing the hard part of the arbitrage prefer to lock in longer-term profits. Other considerations. So far, we've talked exclusively about gold futures, but a similar no-arbitrage argument could be made about other futures as well. However, the specific details would change and the result would be different. For example, we've seen that the futures price of gold is actually less than the equilibrium price of the arbitrage. We theorize that this is because large gold holders might not be willing to part with their gold, even temporarily. For other commodities like oil, we don't need to speculate because we know this to be true. For example, oil refineries are some of the largest holders of crude oil, but they wouldn't be willing to engage in the arbitrage because there's a very material difference between having the commodity and having a futures contract. One can be refined and the other can't. The preference for having the real thing over the derivative can be expressed as a convenience yield C that just slots into our formula. S times e raised to the power of r minus c times t. Another interesting example are stock indices. Since you can't deliver an index, these are cash settled, which means both halves of the arbitrage are easy to do. While there's no storage cost to worry about, there are dividends to contend with. These make the buy index sell future half cheaper, so the equilibrium price becomes S times e raised to the power of r minus y times t, where y is the dividend yield of the index. For example, here are the computed prices of the E-mini S&P 500 contract traded on CME. We're using $5,732.94 as the value of the underlying. Table 2. The real CME and calculated prices for the next 6 expirations of the E-mini S&P 500 futures contract. The columns are the same as in Table 1. It's worth mentioning that the traded volume drops off a cliff the further out we go. The estimated volume was over 1 million for the December expiration and was under 100 for the June one. So the distant expirations don't seem to be arbitraged much. We see that the difference between the risk-free interest rate and the one implied by the prices is around 1 to 1.5%, which seems about right for the dividend yield of the S&P 500. An aspect worth discussing is the difference between forwards and futures. Forwards are usually traded OTC and can't have any expiration date. Futures are usually traded on exchange and all expire on a particular day of the month. The more important difference is that futures are marked to market daily, which results in some cash flow while holding the contract. Since we've been ignoring this mark-to-market aspect, we've actually been talking about forwards this entire post. That said, it can be shown that futures and forwards prices should be equal under certain common circumstances. See Technical Note 24 from Options, Futures, and Other Derivatives by John C. Hull. Mind you, when all is said and done, a future can really be anything branded as such. For example, interest rate futures are constructed very differently from commodity or stock futures. They also behave differently with regards to the underlying, so our no-arbitrage argument just can't be applied to them. Finally, a word of warning about relying on the equilibrium price of the arbitrage. Like with every other property of the market emerging from trader behavior, it sometimes stops being true, especially when the market is stressed. For example, during the 1987 Black Monday crash, S&P 500 futures were trading several percentage points lower than the actual index, and it took a few days for this state of affairs to resolve itself. Conclusion. In this post, we looked at the relationship between the spot and futures prices. We derived a no-arbitrage argument which showed that the futures price should be the spot price increased by a combination of several rates, most notably the interest rate. We also saw a few examples of how this doesn't quite work in practice. When I first heard this argument, it was 10 years ago, and I was just told, oh yeah, the futures and the index price are the same. This didn't make sense to me at the time, but with the benefit of hindsight, I can see how somebody might use that as a shorthand in a zero interest rate environment. The data and references for this post are available at marketunpack.com. Thank you for listening.